Hi, I'm Nate. Welcome to Stratum, the most powerful, versatile tax planning and projection system on the planet. We've been working with John E. and Janie Johnson. We've been through a few strategies with them to optimize their taxes, their income, and their assets. And at this point, they're quite solvent, with $3.5 million left projected at life expectancy. However, there is an element of their financial life that we have not taken into account, and that is this. If we go back and look at the data that we scraped from their tax return back in the beginning, we can see that they have a little bit of income from some partnership or S Corp. There are clearly two entities because there are two lines on the tax return, one with about $23,000, the other with $5,000 of income. So these are not substantial entities and might be used as bits of tax shelters in themselves. What we do know, though, is that there is some income. So, assuming that they are a going concern and potentially transferable, there is something that could be done with them. Let's look at what might be done in terms of a business liquidation for them. In aggregate, those two businesses might be worth somewhere in the neighborhood of $100,000. That's 4x revenue, but after some number of years. So it's a ballpark number with maybe $10,000 of basis. We'll assume there's been no depreciation to recapture. That gives us a $90,000 capital gain, 90% profit, and 10% basis ratio. The sale could happen in one every year. We'll pin that to retirement, just knowing that that tends to be a low income year. And in this case, those are both owned by John, as evidenced by what was scraped from the tax return. At the time of sale, our wages and salaries are not tied to this business, although they also do stop in that year. The partnership and S Corp income on both will stop again. We're lumping these into one. We might even note that here where we're treating the two business entities together for this illustration. And since we're not dealing with large dollars here, that should be quite acceptable. But those two income streams will stop. They may be set to stop in that year anyway, probably are. But in this event, we'll set those just to make sure that those do stop at the time of sale. Okay, so let's save that off. Now, if we look at our tax, let's look at the tax projection first. First of all, without that business liquidation, you can see that in 2036, our total tax bill was about $13,000, $14,000. When we add the business liquidation as a one-time sale, it goes up quite a little bit in that year. As a comparison, if we wanted to do an installment sale over 5 years at 5% interest, that's a $20,000 payment with an annual gain of $18,000, and we'll get some interest out of it. I'll save that off. And you can see how we've spread out the tax liability over time. We could also look at that same comparison using a federal tax analysis view. In this case, we're comparing 2035, this is the year before retirement, to 2036, which happens to be the year of retirement and the year of the sale. And we can watch what happens to our values. The partnership has some income here, capital gains and losses at 12,000. If I just turn that off, we can watch these numbers change between 58 down to 38. Now, it's really only $18,000 of gain, but what's happening is that there's some other interplay going on with other assets. And as a result, we actually get about a $20,000 difference in our capital gain. But comparatively, that's how those 2 years play out. Partnership income stops, we get a little additional capital gain, and our total taxes amount to $21,000. Again, turning that off, we're down to 13,800. Now let's swap that back from the installment sale to the one-time sale, and you can see that we're up to $44,000 of taxes. That's a fairly substantial difference. Now, that only, again, looks at that 1 year, and it's a few years out. We could also look at it holistically here, where the business liquidation has a negative tax impact. And you can see here, the net present value is actually stronger than the nominal, which means that there is some interplay. We have some additional income and, of course, an additional portfolio value. At the end, we can do that same thing we did a minute ago. If we swap that out to the installment sale, we can see how that impacts taxes. Nominal taxes went up, right? Tax savings went down. But our NPV taxes actually went down, meaning we have less negative savings in the NPV sense. Final portfolio value looks to be about the same. Now, we've done quite a little bit of bouncing back and forth, turning things on and off, and that's fine. In fact, I kind of like that this system allows us to do that. on on display real time. Let's do it another way. Let's do a scenario. We haven't done any of this yet. Let's take this scenario, which is our main scenario, and let's just duplicate it. We'll make a copy of it. And we're actually going to call this business installment sale. And the reasoning is that we can now take that scenario and treat it differently and give us a means for comparison. So we are still looking at our main scenario. Let's make sure that the strategy for business liquidation is set to installment sale. No, sorry, one-time sale. Then let's go to the other scenario, which is our installment sale scenario. And now let's change this off to the installment sale, which it was because that's what it was when we copied it. Now, if I go over to the compare, I have two different scenarios to look at, and I can see the difference between the two. In this case, the installment sale has a lifetime tax of $1,037,000, the one-time sale of $1,022,000 in absolute dollars. In net present value dollars, the installment sale is actually lower, 502 versus 504. This is exactly what we saw just a minute ago in the summary tab. These are not huge differences, but we can see how they play out in comparison stacked on top of each other over time. Marginal rate, probably as expected, we're pushing assets out an additional year. Effective rate, we can see how the blue line being the main scenario, we get a little higher tax right there in that first year of sale versus the installment sale that levels things out a little bit. Same thing with the total tax. We would expect more when we do a lump sum sale in 2036. Look, there's a whole lot more here. Thanks for being here.